Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Hopefully, this is not your retirement plan. But I would imagine most of you probably don't even have more than what's in this little mason jar for your retirement. There are tons of risks of people running out of money in retirement. But when you think of risk, it's like, do I have enough? Or maybe you have accumulated some money and you're like, okay, well here, what about market risk? Am I gonna lose all the money that I've accumulated to the overall market? I'm telling you what here, there are many, many more risks that could jeopardize your retirement that you don't even know. That's what we're gonna get in today. Welcome to the show, everyone. Show's called Your Money, Your Wealth. My name is Joe Anderson, certified financial planner, president of Pure Financial Advisors. And I'm with the big man, of course, Mr. Alan Clopine. He'll be joining us in just a second. But when you look at retirement, they are filled with risks. You have term risk, credit risk, inflation risk, longevity risk, political risk, tax. I could go on and on and on. I don't want to bore you. But that's what we're going to get into today. That is the Financial Focus. Here's the problem. This bar graph is explaining of what percentage of income that people can afford in their overall retirement. If you look back in the 80s, right, 30% of people could not afford their accustomed lifestyle. If you go to today, it's more than 50% are going into retirement that have no clue actually how much money that they need, but they're walking in with a lot less money than they need. To help bring this down, it's because of pensions, right? Before we had big pension plans. If you take a look at the landscape of retirement, right? Before you had large defined benefit plans. I worked for an employer for 30 years. I retired, got the gold watch, and then after that, I got a nice defined benefit plan. That is not the case today. We have defined contribution plans. That's the 401ks, the 403bs, the TSPs of the world. So it's your responsibility to save in those plans. But guess what? Before, the company took all the risks. Now the risks are on your shoulders, and you have to identify all of these different risks that could jeopardize your retirement so you have a better retirement. That's what we're getting into, so help me out. Let's bring in the big man, Mr. Clopine. Alan, if you take a look, not many years ago, right, most companies had the defined benefit plan. So they took all the risks. Now they're saying, hey, we don't want that risk. Let's bring it on to the employees. They need to learn how to save. They need to understand taxes. They need to understand the markets and everything else. But most people, A, are not saving enough, and B, they have no clue about all these risks that are facing them.
You know, Joe, that last graph was pretty telling because in 1983, over 60% of people that have in private companies had pensions, and now it's around 10 or 15%. So it's a lot different, and what's replaced that, of course, is the 401k. And the 401k, now we got to figure out how to save, and it's not that complicated. I mean, you take some money out of your paycheck and save. A lot of us are not doing it, so we do need to save more. We'll get into that in a little bit, but there's a lot of risks that you may or may not even be aware of in retirement. And here's a few of them. The first one, of course, is outliving your money, and as Joe just said, now over 50% of folks going into retirement cannot afford their same lifestyle, so that's a big concern. Stock market risk. We all know the stock market is volatile, especially these days. What do you do about that? And then how about higher taxes? Are you afraid taxes may become higher at some point in the future? And then what about your health? Of course, health, we don't really know exactly what's going to happen as we grow older, but we need to have a plan for it. And Joe, it's these four things, and we're actually going to go over 4 more things at the very end of the show, but there's a lot of things you got to watch out for when you think about retirement.
Unfortunately, it's not easy, right? And especially today, there's a lot more that people have to take a look at. It's like, all right, well, A, how long are you going to live? No one knows that answer. When are you going to take your Social Security benefits? Do you take it right away? Do you push it out? How much money should you be saving on a monthly basis, annual basis to make sure that you can provide the goals? So there's a lot of things that you have to take a look at. And probably the biggest worry that most people have when you approach retirement, and I know you're laying in bed right now, but you know the answer, is that you don't want to run out of money. You don't want to be a burden onto anyone.
Yeah, Joe, and if you look at this is Allianz Life did a study a couple years ago. These are 40-year-olds from age 44 to 49, and the vast majority fear running out of money more than death. running out of money is more fearful than death. And you can see there's a couple graphs here. There's one with dependents and one without dependents. But Joe, that's a pretty telling statistic. Now, you're in your 40s.
Well, yeah, because you're in your 40s. I'm not thinking about death when you're in your 40s. When you're in your 80s, it might be.
So
I don't care about running out of money.
Are you more worried about running out of money than death?
I am. Well, I don't know. It depends on what lifestyle you live, right? So no, I'm worried about running out of money.
Okay. All right. Well, let's talk about some solutions for that. So I guess right off the bat, when you're planning for retirement, we're living a lot longer, so you need to plan for 2 or 3 decades of retirement. Make sure you maximize your saving opportunities. So that's IRAs, that's 401ks, 403bs. It's saving money outside of retirement too. Now here's one that you may or may not want to hear, but it's true. A lot of people are going to have to work longer. You may want to delay retirement and delay Social Security benefits to get a much higher level. And then finally, when you do retire, learn what you actually can spend, what a sustainable spending level is, Joe, because if you don't know what you can spend, you'll run out of money.
Yeah, I'll go through an example then in a minute, because I think a lot of times you want to go through like a dry run. So if you're 10 years from retirement, you're like, okay, am I on track? What is the math involved with me sustaining a retirement that I'm looking forward to? How much money do I need? What is the solution? But first things first, you have to look at, okay, well, should I retire now or should I retire later? If you delay your retirement, a lot of really good things happen. People want to retire at age 62. I'm telling you, people should be looking at retiring at age 70. 70 is the new 50, folks. It's okay to push out your retirement, because if you can push this out a little bit, really good things can potentially happen to your overall retirement, Al.
Yeah, Joe, and we have an example where if you retire at 66 versus 70, it makes a really big difference in how much you can actually have as far as income and how much you can spend.
Right. If you take a look at a 66-year-old, let's say you have $500,000. If you could push that out 4 years, you almost have $800,000 saved. That's assuming if you're fully funding your 401k plan. Plus your Social Security benefits go to $26,000 to about $35,000. And then if you take that 4% distribution, right, that's $46,000 to about $66,000. That's a significant increase just by working a few more years, just a couple of more years. I know a lot of you just say, no, I can't work anymore. I want to get the heck out of this job, right? I think our producer is feeling that. Our camera people are feeling that this morning. But you know what? If you just stick in there, just for a couple more years, really good things can happen.
That's really good advice
for
our people here.
But this is what I want you to focus in on. If you look at a sustainable distribution rate, so let's figure out, all right, well, let's do a dry run here. What is the math involved? And if we could go to this little screen, that would be appreciative, because if you have $500,000 saved, right, there's your 500 grand. So you just take a look at how much money that you have saved up. Then you look at, okay, well, how much money is going to come to me in Social Security benefit? That's this little guy here. Then if you're lucky enough to have a pension, that's this little guy there. So you add up your fixed income sources. That's extremely important. Start there. What do you think your assumed benefit's going to be in regards to your pension? What's the assumed benefit's going to be in regards to Social Security? Then take a look at your benefit. How much money that you have saved, your IRAs, 401ks, in this little 4% rule right here. That 4% rule, take that and divide it into the $500,000. I made a huge mess of this, but that's what your retirement looks like. It's a mess because you don't know what you're doing. Take 4% of the amount, that's $20,000. That can give you a dry run to say, you know what, I can spend $75,000. If you're spending $125,000, I'm telling you, you're going to run out of money. Just start with the basics. Figure out the mathematics or the arithmetic when it comes to your overall retirement, and you'll have more confidence on how much money, that you can save, right? And then you're going to get fired up. You're going to say, you know what, we can do this. You're going to save a little bit more money. You're going to get a little bit more disciplined. That's what it takes. You just have to identify the risks that are facing you and making sure that you do everything you can to avoid them.
Yeah, Joe, and a couple things to mention about this 4% rule. Of course, it depends upon how old you are. The older you are, the more you can withdraw and have a bigger sustainable income. And there's going to be other factors, too, in terms of your longevity, right, and your health and things of that sort. So this is just a starting point, and I think people need to realize this. This is kind of back-of-the-envelope starting point. You need to do a little bit more planning to get this even closer.
Yeah, but if you do this, you're way ahead of the game. Most people walk into retirement with that little cookie jar with $32. right?
Yeah.
And then they want to spend 200.
Yeah,
right?
we see that all the time.
It just
and we
doesn't-
see the opposite too. People have 10 million bucks and
Right.
they don't want to spend 50 bucks.
Right. Yeah, exactly. They're like, no, I don't want to run out of money. So if you get a plan in place, you're going to enjoy your retirement. You're going to have a lot more confidence. Don't go anywhere because we have a lot more to discuss. There's a lot more risks out there that you probably don't even know of. We're here to uncover them so you identify them and you do everything you can to hedge against them. Good morning, everyone. You're watching Your Money, Your Wealth. Don't go anywhere. Welcome back. Welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here. I'm with Alan Clopine. We're talking about the risks that you probably don't even know that you're facing in regards to your retirement. Before we dive into that, let's see how you did on the true-false question.
To reduce my investment risk, I should invest more in CDs, T-bills, and other fixed income investments, and less in stocks. Well, that's certainly true. Certainly stocks are more risky than fixed income. But Joe, that doesn't really consider another risk, which is inflation, does it?
Yeah, well, then you have other types of investment risk in regards to bonds. You have term risk, you have credit risk, depending on the credit quality of the company that you might be investing in or how long the term of the bond is. So there's all sorts of different things that people need to know in regards to your overall investment strategy. It's not like stocks versus bonds, all right, there's more risk in this versus that. You have to identify all risks in regards to your retirement to make sure that you have a healthy, successful one.
Yeah, that is true, Joe. And so when you think about retirement, we are going to get into a risk here shortly, which is the stock market risk. You probably do know about that one, so we're going to talk about that. But before that, Joe, let's see how you do on this week's client question.
Could you tell me some of the pros and cons of investing in tips?
Could I have a glass of tea? Tips. I think she's referring to a Treasury inflated protected security. A tip. Here's a tip for you. All right. So when you look at a Treasury that's backed by the U.S. government, it's very safe, right? You're not getting a lot of interest, though. So that's the problem. It's like, okay, well, here, I want a very safe instrument or a security, but how am I going to outpace inflation? So they came up with what is called a Treasury inflated protected security, or a TIP. Basically, the interest that you are credited on a TIP is based on the CPI index, Consumer Price Index, or inflation. So as the CPI index goes up, the amount of interest that you get credited goes up as well. Be careful, though, with a tip, depending on where you hold it in your overall investment account, because the downside here is that you're still not getting a ton of interest, but it's the interest that you do receive, or the income that you do receive, is phantom income. So you probably want to hold those more in a retirement account versus a trust account. Boom.
Nicely done, my friend. And tips, they are fixed income, but they tend to have a little bit more volatility because of the way that the interest is credited. So I guess with that, maybe we'll go right into the stock market. You probably do know about stock market risk, but do you know this? Do you know that most of you are not even receiving market returns? And that's for a couple main reasons. One is you're getting in and out of the market in the wrong time, and another is diversification. So look at this Dalbar study. This is the last 20 years' returns through December 2014. The S&P earned about 10%. The average investor earned a little over 5%, or about half of the market rate of return. You look at the bond index, same problem. The bond index was about 6%. The average bond investor, fixed income, earned about 1%, if that. So here's what you need to think about is when you're investing, it's better to stay in the market. And I know that gets difficult when times are volatile, because your tendency at times like these when the market is volatile is to pull out. It's too risky, wait for the market to improve, but you will invariably, in most cases, make the wrong decision. And Joe, we see that again and again in terms of our emotions kind of get in the way of proper investing.
Well, yeah, fear and greed is alive and well when it comes to your money. We're twice as fearful to lose $1 than we are to gain $1. And so as soon as we see volatility in the short term of the overall markets, what most people do is that they want to go to a safe haven. It's called flight to quality. So they get out of stocks and they go into bonds right when the market's down. And then when the market goes back up, you know the story. Guess what? We feel better about ourselves. We feel better about the economy. We feel better about the overall stock market. So then we buy back in. That is a recipe for disaster in regards to your overall overall investment strategy. So what are the tips that you should do? Well, first of all, you should have a globally diversified portfolio based on your needs and wants. Control the things that you can control. Control your costs, right? You take a look at what investments that you're in. Are you in high cost investments? Or are you in lower cost investments? Then determine the risk parameters, how much money you have in stocks versus bonds. This is all going to depend on what your income need is, what the demand of the portfolio is, what the risk tolerance is. And then you want to be diversified, right? You want to have some money here in the U.S. Of course you want to have some money internationally. We get this quite a bit. Well, no, I want to buy what I know. I only want to stay here in the S&P 500. Guess what? Most things that you use every single day is built by an international company. So you're missing 60% of the market capitalization if you don't invest internationally. Then you can get a little bit more sophisticated in the investment strategies, such as how much money do you have in smaller companies versus larger companies, or maybe value companies versus growth, and all sorts of different things that you can do. This is where you want to spend some time, Al. It's not like, hey, should I be getting in and out of the overall markets? You should be paying attention more on what the allocation should be and then managing that allocation towards your specific goals.
I completely agree with that. And then it's Joe, it's not just buying and holding and forgetting. You get the right allocation. It takes a little planning to figure that out. Get all the different components, and then as one starts to go up more than the other, you want to rebalance. You want to take some profits off the table on the ones that have done well, and you want to buy the ones that have not done as well, because everything cycles at different times. So Joe, here's another thing, another risk is income taxes. And there's a lot of concern that taxes may become higher in the futures, and it's important to know how retirement income is taxed. So you look at pensions, IRAs, 401ks, well, they are taxed at ordinary income rates. Those are the highest of tax rates. Social Security is also taxed at ordinary income rates, although there is a component of that that's tax-free, 15% all the way to 100% tax-free, depending upon your income level. But look at this, capital gains, qualified dividends, those get a special capital gain treatment, which is usually about 15% tax. For some of you, there is no tax. And Joe, the absolute best one is Roth conversions and municipal bonds, because those are tax-free. So if we could only get some more money in Roth IRAs, Joe, we'd be a lot better off, wouldn't we?
Well, I mean, it's not what you earn, it's what you keep. And then so unfortunately, people take on a ton of risk in their overall portfolio to try to maximize their overall return. But they don't have the capacity for taking that types of risk, as we just saw, because as markets, if you're trying to get high returns, you have to take higher risks. But then when the market turns in Korea, you get nervous, and then so you pull out. So you're losing that return that you're shooting for in the first place. And then you take a look at where's that money held. Most of it's in a retirement account that's going to be taxed at the highest of rates. So you're taking on a ton of risk. You're not managing the assets appropriately, or not you, but most people, right? Not you, of course not you.
Our listeners are very good.
Yes, our viewers. Not them, just everyone else around you, of course. Right? But then you have to take a look at taxes. If everything now is in a tax-free component, your money's going to last that much longer. So if you look at a Roth IRA, what's the best way to put money in there? All right, well, there's contributions, right, Al?
Yeah, you do contributions, and that would be $5,500 per year, $6,500 if you're 50 and older. Now, there are some income limitations. If you make, as a married couple, more than $193,000, and single is $132,000, $133,000, something like that. Now, that's how you have to have earned income, though, as well. In other words, you have to have a job. Another one is a Roth 401k. You're allowed to do contributions in that. And Joe, a lot of people don't realize that there are no income limitations. If your 401k has a Roth component, you can put $18,000 into that Roth component. You do not get a tax deduction, but it grows 100% tax-free.
Yeah, I would encourage everyone to make sure that you understand if there is a Roth provision in the 401k plan. Most people don't know if they have one or not because they haven't asked. I would say most companies, larger companies, now have the Roth provision in your 401k. So that's a great way to get a little bit more money into a Roth account or a tax-free account, because A, there's no income limitations, and if you're over 50, you can put $24,000 into that versus the $5,500 or $6,500 that you can put into a Roth IRA. And guess what? You can do both. If you put money into a Roth 401k, you can also contribute to a Roth IRA, as long as you qualify under AGI limitations. Then the big bang for your buck, Bud, is what? The Roth conversions.
It is, Joe. And so the Roth conversion, anybody can do those. And this is relatively new. And the conversion has been around since 1997. But it used to be you had to make less than $100,000 to do a conversion. Now everybody can do a conversion, whether they're working or not. And a lot of people don't realize this. A conversion is taking money out of your IRA or 401k and converting it to a Roth. So the downside is you will pay tax on that conversion, so be careful of what tax bracket that you're in and the tax bracket that you're going to be in retirement. Take a look at those so that you're not paying too much tax on the conversion, but that's a way to get a lot of money in. We've had cases where people have had big tax deductions and converted $50,000, $100,000 or more, and all of a sudden, Joe, you get a lot of money in a Roth that starts growing tax-free. Now you've got some control over your taxes in retirement.
Yeah, I mean, the Roth, in most cases, will be your head against higher taxes and higher inflation, right? Because as inflation goes up, you have a pool of money that you can draw from that is not going to be taxed. Also, when you take a look at healthcare, right? We all know that healthcare expenses are going up. If you look at the recent study by Fidelity here, a married couple is going to spend $245,000 just in like copays. This is not Medicare premiums. This is copays and other things that you need just for healthcare. So if you have, and this is not long-term care as well. So if you have money in a tax-free component, right? Maybe you pull from there. If you have to pull out a larger dollar figure one given year, if you have money in that tax-free pool, you can pull there and it's not going to blow up your tax bracket, right? We see people that take large distributions for emergencies or health, health issues, and then guess what? They're going to have to pull out twice as much just to pay the tax on the distribution to take care of them.
Yeah, and one other thing, Joe, now health care is generally deductible as an itemized deduction, but you have to get over 7.5% of income if you're over 65 or 10% if you're under 65. In other words, you may not be able to deduct those medical expenses. So again, it's important that you get some money in tax-free so that you can afford your lifestyle and things that may come up like health care.
All right, we got to get out of here. We got to take a break. Don't go anywhere. When we get back, we're going to talk about just some other miscellaneous risks that you're taking, and then we're going to flip the show to you, and then we're going to answer your email questions. We got some good ones today, so stick around. Show's called Your Money, Your Wealth. Welcome back to the show. Show's called Your Money or Wealth. Joe Anderson, Big Al, Clopine, hanging out. Wrapping things up today. Before we do, we got to go to the true-false question to test your knowledge when it comes to financial matters. Let's see what you got.
I can give my children their inheritance before I die so they can avoid having to pay estate taxes. The answer to that is false. A lot of people don't realize that when you give a gift to a child, then if it's more than $14,000, that will generate gift taxes. And gift taxes, before you get too excited about that, all you have to do is fill out a gift tax return. It reduces your estate tax credit in the future. So, but those two are tied together, so you don't avoid estate taxes by doing a gift.
Yeah, and what happens is basically you give a gift and then the giftor takes your basis.
True.
So if you give them cash, you're good, but if you give them appreciated asset when they sell it, then they'll have to pay tax. So, all right, looking at wrapping things up with when it comes to risk, there's a lot of things here. There's sequence of return risk that you also have to make sure that you look at. Long-term care risks. There's all sorts of things. Bad advice, right? You might be working with an advisor, but he might not understand or she might not understand tax code. He might not understand all sorts of different things, or you might get busted in some fraud.
Yeah,
we've seen a lot of that as well.
We have, Joe, especially some of the identity fraud these days. In fact, there's a lot of people out, not a lot, but there's some people out there that are calling you and pretending to be the IRS, and they're saying they need your account number so that you can pay this tax that you owe. And guess what? A lot of people are falling for it. Don't fall for it. The IRS does not call you. They send you letters. In fact, they'll only call you once they've already engaged with you and you give them permission to call you. But that's not the only scam. There's a lot of scams out there, and so be careful. There's a lot of con men out there.
Yeah, right. Identity theft is one of the fastest growing thefts out there. Yeah. And as Al said, the IRS will never call you. Right? They send you letters, certified if you're really bad.
Right.
So let's switch it up here. Let's switch the show to our viewers and see what we got for emails this week.
All right, this is from Bobby in Mira Mesa. My wife and I have our own separate retirement funds. If we divorce, will those accounts be considered our respective separate property? Bobby, I hope you changed your name for this, and because it sounds like you're not yet divorced. But
well,
the answer is no. In fact, all of your assets, including retirement accounts, are going to be kind of split 50-50.
It's called a quadro.
It's called a quadro, right. In other words, the assets, maybe you have more assets than her or vice versa, and it will be evened out in what's called a quadro account. So yeah, it'll be split. unfortunately.
Yeah, and also, I mean, because retirement accounts are separate property, and then it also determines on when you accumulated those assets. If you just got, so I would consult a divorce attorney,
Yes.
And then you can look at, all right, well, here, I want to keep this. You can, yeah, you have to go through a long process instead of a quick email on your money or wealth.
Yeah.
This is interesting. At the end of the show, you right here, Big Al.
Yeah, I decided to sit next to you.
Kind of ruining my style.
I know, because usually you close
So I
without
kind
me.
of like to just have the whole desk here. To my
Here, I'm gonna do your move too.
Yes, all right. Sounds good. Hey, join us next week because we got a lot more to go. We're going to talk about financial planning. Imagine that for a concept. Good morning, everyone.